Good morning, everyone. Welcome to this rundown for global stocks for the 25th of October. And over the last week or two, it's become increasingly apparent that the correction was probably complete. I think there's absolutely no doubt about it now. And the circumstances that we've got in place are actually a recipe for a decent sized rally. Now, I'm not saying that that will happen. I think a sideways broad volatile range is also possible, but certainly the elements for a big rally and new highs in the S&P above 2140 are now possible. The circumstances are certainly there. So let's jump in and have a look at what actually propelled the market action last week. The S&P index ended up higher by 42 points on the week. It was a strong week, and these are the elements that lead me to suggest that a big rally is possible from here. And we've already had a pretty decent rebound from that selling in late August and again in September. So we've seen expanding volume. So this has not just been a price rally that could have possibly been driven by short covering, for instance. Volume has really expanded on this rally, and the price momentum is actually accelerating. As we've gone further into this rebound, the price action is actually accelerating. That's a tremendously strong sign. We've got the RSI is being maintained above 60. Now, in a bear market, you almost never see the RSI get back above 60. It goes down to 30, 20, and you get counter trend rebounds in a bear market, but they generally stay with an RSI below 50. They just kind of limp up there a little bit. And we've not, this has just not got the hallmarks of a bear market rally. The other thing is that the VIX is below 17, and again in a bear market you tend to get the VIX higher than that. It forms a higher base. So none of these things occur in a bear market rally. So I think the chances of this market going down again are extremely slim. The other thing that whenever I look at stock markets, I always look at things from a self-interest point of view. Who's going to benefit, and what is in the self-interest of the major players? Because at the end of the day, that's what drives people's decisions in the market. What works for them? And so if you always look at the market through a lens of self-interest, it quite often gives you a really good insight. And one of the things that I have been able to establish is that a lot of fund managers, a lot of hedge funds, have actually been caught out, and they're not on board this massive rebound, because a lot of fund managers have moved to substantial levels of cash, and that cash hasn't gone back into the market. So looking at that from a self-interest point of view, these fund managers are going to need to chase performance into the year end, because the worst thing for a fund manager is if the market is going up and some people are making money, but they're not, because their clients then want to take their money out and put it in another fund. So fund managers, irrespective of what they think about the market and what they think about valuations, are to a degree going to need to chase performance. And again, that's just another driver of the market. So from my perspective, there's been no earnings recession. We're seeing the earnings season now progressing, and whilst it's the earnings rises they're not spectacular, but they're still going up. By and large, revenues are still going up, profits are still going up, and they're beating expectations. Now, the expectations are pretty low, I'll grant you that, but they're still beating expectations. So we don't have a recession in earnings, and we have no prospect of an economic recession in America. GDP looks like being around 3 to 3.5%. Into next year, so really no prospect of an economic recession. And under those circumstances, there's never been a bear market without an economic recession. So it's pretty hard to see one now. So for me, the answer is very, very simple. There will not be a bear market, and the bearish brigade that always come out of the woodwork when the market gets a little bit unstable have yet again got egg on their face. and they've just come out with all sorts of one-sided arguments as to why we've got a bear market. They use the statistics very selectively. But if you look on a broader level, it's critical to look both at fundamentals and technical patterns. If you're just a fundamentalist, then there can be things happening that that the fundamentals aren't giving you a sufficient enough early warning sign. If you're just a technical person, and I think a lot of technical people jumped on the bear market bandwagon because they saw breakdowns, technical breakdowns, and so they assumed that that would then lead to a bear market. But they didn't stop to think about the fundamentals. They didn't stop to think about valuations or the lack of an economic recession or all those other drivers that I presented on the previous slide. So you've really got to look at both. And that's why, I've been steadfast all through this that we weren't going into a bear market. I didn't know the depth, whether we would get a lower low during that correction, but I think it's pretty obvious now that that's not going to happen. So let's take a look at the S&P 500 index. We'll start with the daily chart. And you can see this little dotted line here, which was resistance we had a bit over a week ago at 2020. The index went up to it, pulled back for 2 days, but those 2 days were relatively small range days, and then it broke above it. The key resistance was these lows formed on the 8th of July. So we paused for a couple of days, and then we just blasted through that on Thursday, and then gapped higher and then went on with it on Friday. So that break on Thursday and Friday is incredibly powerful. And when we look at the NASDAQ index, you'll see something that you don't normally see in an index as big as the NASDAQ on Friday. Now we are getting a little bit overbought, so I wouldn't be surprised any day to see a bit of a pullback. But you've just got to look at this, the power of this rebound and the fact that it's just absolutely blown away these resistance levels with only a 1 or 2 day pause, and that tells you all you need to know about the momentum in the market. Just viewed from a monthly basis, we've been looking at this chart now for over a year, and you can see that it played out in very similar fashion to August, September, October 2011. October was weak, closed off the lows. September was weak, and October powered back and then led the rally, which went through until May of 2012. So we've seen almost an identical pattern in August, September, and October this time round. So enormous strength there. Let's just look at the NASDAQ index, because this is really interesting. You can see we've had a pretty strong rebound, but then we got this massive gap on Friday from where the market closed on Thursday to where it opened on Friday. And that's because there was some really strong earnings came out from Microsoft, from Facebook, from Amazon, and they all contributed to this massive gap in the NASDAQ. So some terrific performances there. Now, the only index that is still lagging a little bit is this is the Russell 2000 on a weekly chart. So you can see we haven't really had the rebound in the small caps. And on one level, you could look at that and say, well, that's not a good thing because the rest of the market is not joining in. But I've actually done some digging, and it's pretty normal for small cap stocks in September and October to be underperformers. They don't tend to kick in from a seasonal perspective until November, December. That's a much better period for small caps. So I'm not too fazed by the fact that the Russell 2000 is lagging. There's so many other positives that are going on at the moment. Let's look now at the VIX index. This is the other reason that again, you look at self-interest. The reason that the VIX spiked in late August is because people became incredibly fearful and they wanted to protect their portfolio, and so they bought put options. So that's what drove the VIX from around 14 to almost 40. The speed with which this VIX has come back down to be down at 14 again just indicates that people have now just completely abandoned the need for, or not completely abandoned, but substantially abandoned the need for put option insurance. And because everybody acts in their own best self-interest, then that tells you that the level of fear that drove that correction in late August, which was really started by the Chinese devaluation of the yuan, that was really the catalyst that started it all. And that tells you now that the fears surrounding China, the fact that the Chinese economy might implode, that's all but disappeared, and hence the rally. Now let's move on to the Australian market, and the Australian dollar is still in a little bit of a counter trend rally. It's probably developing more now into just a bit of a sideways pattern. And it's been just tracking around in a range between 69 and 74 cents. 75 is possible at the upper end. We might get a minor peep above that level, but I'm still very firmly of the view that we'll see the Australian dollar below 70 cents by year end as the American dollar picks up pace. And again, the fundamental drivers, that's not just looking at it from a charting point of view, that's looking at the fundamental drivers. It's quite likely that the RBA will be forced to lower interest rates in Australia. The move by the four big banks to raise their mortgage lending rates by 15 to 20 basis points is going to make it difficult for the RBA not to lower the rates. And at the same time, the US Fed is really wants to move, if they possibly can, on raising interest rates. So if the Fed goes up, the RBA goes down, that's going to drive the Australian dollar under 70. The index was higher by 82 on the week, but that all happened on Friday, and that was a bit of a precursor to the earnings announcements for those major stocks, Microsoft, Facebook, Amazon, etc. So we saw a pretty strong surge on Friday. Just looking at gold briefly, gold was lower by $10 for the week, and that was really because the American dollar went up. So again, no change in gold. Gold stocks still struggling to confirm what's going on with the precious metals itself. So I just don't see any change there. I think we've just got more sideways action happening. So turning to the Australian market, this is the ASX 200. You can see that we had a pretty strong rebound from the end of September, but that then petered out and we got stuck in this range here for about 10 days between 51.70 and about just under 5,300. But a strong burst on Friday, and we may well see some more gains on Monday. But look, I really find it hard to see what's going to drive the Australian market much higher. I certainly do not subscribe at all to a lot of the analysts that are calling for 6,000 points by the end of the year. I just cannot possibly see what's going to drive that. We might limp up to 5,500, but I reckon that'd be about it. So not expecting very much, and we've certainly got some resistance here. These lows here that were formed, these lows here from June and July, the market's got to get through those first. So I'm not getting too excited about the Australian market at this stage. Just looking at the Australian dollar, there you can see we've definitely still got a downtrend. The red 150-day moving average line still declining at quite a decent rate. The price of the dollar is well comfortably below the moving average. The last time it was able to rally up to the moving average was in May. Yes, we've got a short-term sideways range, but I think every chance we'll be back down under 70 by the end of the year. Now, just turning to gold. So this is gold on a daily chart. We had a nice rally, but we've also had about 5 or 6 sessions out of 7 down for gold. Let's look at it on a weekly chart, and the weekly chart just shows that there's really nothing happening yet with gold. And if we then go to the gold stocks, this is the HUI index. my mind a little bit of encouragement, and certainly there's been a few Australian gold stocks that have done much better. Um, but really on a broad global basis, gold stocks really not joining in as yet. Copper dropped to $2.35, and again, this is just US dollar impact. Crude oil was down by 45, down to 45 for the same reason, and it just remains stuck in this range between 42 and 50. The question is this a pause in what would be deemed to be a continuation pattern? In other words, we're going sideways in a range for a while, and then we'll go further below 42. Or is the selling done? Is 42 the low and we go up from here, which would be an accumulation phase? I don't know the answer to that question. The fundamental drivers, to me, I think there's a reasonable chance we could see oil at $30 a barrel, just because of the way that the supply and demand dynamics work. There's not enough supply has been driven out of the market yet. I don't think commodity prices have been low enough to drive that excess supply out of the market for good. So that's why I favour a break of 42 ultimately. But how long it stays in this continuation or accumulation phase, I don't know. But I certainly wouldn't be buying into the energy rebound story just yet. There's the spot copper chart. It's really just been sideways now for some time. So overall, to wrap it up, the correction's complete. Earnings season in America is solid enough. It's not spectacular, but it's solid enough for people to now start taking note of the fundamentals. So I believe the fundamentals and valuations will now start to drive prices again, and not fear as we've seen over the last couple of months. So if you've got cash up your sleeve, which is certainly where you should be, I think it's okay to go for it. But just the overrider, I think in this sort of market, you really want to retain a focus on quality stocks, on earnings reliability for the next couple of years. So you want to be in stocks that are highly likely for their earnings growth to be sustainable, and also value. And I monitor what's going on in the US market pretty closely, and I can tell you that even over the last week or two, if any company misses expectations by or downgrades future guidance, the market is absolutely brutal. 10% drop in a session is almost a minimum, and I've seen anything up to 35% drop in share prices in a session. So that's why it's so important for you to make sure that you're buying quality and you're not just buying any old hyped up stock, because the damage to the stock price is absolutely brutal. So that's wraps it up for this week. Obviously, members are well across all that information. For anyone who's not a member who would like to communicate with me to maybe make some improvements to their trading or investing, there's my contact details there, and I'll be back with you in a week's time. Cheers.